Let's get going. We're going to go ahead and do a quick review. Let's assume we have a business that has four periods with annual cash flows of 50, 65, 85, and 110 during its rapid growth phase. And then its constant growth phase begins at the end of year 4 with an expected growth rate of 3. And we're going to use a required rate of return of equity of 10. Calculate the value of the business. Okay, four periods of constant growth followed by, 4 periods of rapid growth followed by constant growth beginning after year 4. So beginning of year 5. There are 2 sheets going around. You have one that's two written problems on both sides, and then one is the maker's handy, so I'm just going to give it to you. It's a 10. One through 4, it's going to have rapid growth. Starting at the end of year 4, beginning of year 5, it's going to grow at a constant rate of 3%. What is our business valuation? All right, who's got an approach? You don't have to have the answer yet. What are you going to do first? There's a couple of different ways you can approach it. What's the first step? Okay, of what? So where are you going to find the present value? Yes, you're not wrong. Okay, so we'll start with the 4 cash flows that we have. Okay, and find their present values. Okay, we can do that. That will work. So let's go ahead and start with that. So the first one, cash flow of 50 at the end of year 1. How do we figure out what it's worth? Okay. So it would be divided by 1 plus 10, in this case, 0.1, raised to the first power. This one would be 1 plus 0.1 to the second power. This one, 1 plus 0.1 to the third power. This one, 1 plus 0.1 to the fourth power. So that's one way to do it. Or you could treat them all as individual TVM problems. So you could do FV is 50, N is 1, I is 10. Give me the PV. FV is 65, N is 2, I is 10. Give me the PV. 85 is the FV, I is 10, N is 3. 110 is the FV, right? Because these are all FVs. So we're going to bring all of them back. So one way or another, you're going to do that. Another way you could do it is you could do the cash flow register. So one way you could do it is this cash flow register. Make sure you clear it. I have a CF0 of 0, a CO1 of 50, CO2 of 65, CO3 of 85, CO4 of 110, NPV 10, compute, and I get 238. So the PV is 238.16. So that's the PV of the rapid growth phase. When I say it's got a continuous growth of, and we can also do it, we can do it this way too. So we'll do it both ways. So 50 divided by 1.1 is 45.45. I'm going to wind up with some rounding error here. 45.45. 65 divided by 1.1 squared. So 65 divided by 1.1 squared is 53.7. 85 divided by 1.1 cubed is 63.9. And then 110 divided by 1.1 to the fourth is 75.13. So we add those up, 75.13 plus 63.9 plus 53.7 plus 45.45 gives us 238. We'll go with 16. That's just rounding, right? So I got the same answer doing this both ways. Okay. So that tells me how much the first 4 years cash flows are worth. But this is a firm that is what we call a going concern. Right? That's the formal phrase. A going concern means it's in business. It's going. There's no end date, right? Like D-Hop down the street, place where you guys probably eat pizza regularly. It's a going concern. There's no plan to shut it down next week or a year from now or 2 years from now, right? It was there when my wife was here as a student in the 80s, and it's still going, right? Going strong. So it'll probably be going, making pizzas at the end of time when the sun gets ready to burn out. D-Hop will still be making pizzas. So that's the assumption. So we've got what we've basically valued is, hey, D-Hop is in business for 4 years. It's going to make 50, 65, 85, 110. And then after that, it's going to make 110 times 1.03. in year 5, right? So when we say it's got a constant growth rate, what we're saying is if we were to calculate year 5, we take the 110 from year 4 times 1.03, 1 plus the growth rate. That would give us the year 5 earnings. And then we would take, so we'd say, okay, that's going to be 110 times 1.03. That's 113.30. So in year 5, they're going to make 113.30. And then in year 6, they're going to take the 113.30 times what? 1.03, right? 1 plus the growth rate. And you're going to make 116.6. And then in year, what are we up to? 5, 6. Now we're up to year 7. If I want to know how much they're going to make in year 7, what am I going to do? Right, times 1.03 again. So in year 7, they're going to make 120 point whatever. And so on into infinity. It would take a long time to keep going 1.03, 1.03, 1.03, and then we'd have to get take the present value of all that. So what's the shortcut that we already know for if we have a cash flow, like a dividend, for example, right? That's going to grow at a constant rate, and we know that the required rate of return, what's the formula we're going to use to calculate the value of that growing cash flow? So if I have a firm that has a dividend of, say, $1, and I tell you that it's going to grow, that dividend is going to grow forever at 3%. And I tell you that the firm's cost of required rate of return on equity is 10%. What formula are you going to use to calculate the value of that firm? So when we were treating it as a stock price, because this formula is the same, doesn't matter, right? It was EP0 is equal to D0 times 1 plus EG divided by RRE minus EG, right? So this was the last dividend paid. Well, if you just kind of squint a little bit and imagine instead of it being D0, it being cash flow 4, right? We can type it right in. Cash flow 4, the last cash flow, times 1 plus the growth rate, which we said was 3%, divided by the required rate of return on equity, which we said was 10%, minus the growth rate. And there we go. Now we're in business. So it's not really EP0 anymore. Now it is the expected value of the cash flows. What we're trying to figure out is that flow of cash that starts with 110 and grows at a constant rate of 3% forever. It's a going concern, like D-Hop. Been going, it's going to keep on going. Or Wentworth Douglas, right? I don't know when they started, but it was a long time ago. And they're still going to keep on going. So we're going to divide that. So we're going to do, okay, that's 110 times 1.03 is 113.30 divided by 0.1 minus 0.03, that's 0.07. So divided by 0.07, and we get 1,618.57. Now here's the thing. Like when we dealt with this in the stock price, right? When we're dealing with this as stock prices, we're saying, what do we think this firm is worth today? What's a share of this stock worth today? The share of stock was worth, we were valuing it based on the dividends that it was going to pay us. So if the dividend was going to be $110, which is a pretty rich dividend, but there are stocks out there that pay $100 dividends. It's not crazy. So we could just substitute this in because we're not really talking about a dividend anymore. We're talking about a cash flow. and dividends are just cash flows. So, you got to be a little bit flexible with your mind about what these formulas represent. But we're going to use EP0 to represent the value of the cash flows. So what we're saying is the value of that of that set of cash flows, bless you, that begins at the end of year 5, right? But is based on the last cash flow from year 4. That's going to be 110. That's going to be 100 and whatever we said, 114 or whatever, and it's just going to keep on going. It's just keep on getting bigger, and it's just going to go forever. So we're going to shortcut that to say, all right, what's that worth? Well, we would be willing to pay for a cash flow of 110 that grows at an expected annual rate of 3%, and if we evaluated its essential risk as having to return us at least 10%, we would be willing to pay $1,618.57 for that stream of cash flows that's going to go on forever. You'd get it, the 110 every year till you die, then you'd leave it in your will and say, for my dearest grandchild, I bequeath this cash flow and it's going to go on forever. And then when she dies, she'll give it to her grandchildren, so on and so forth. Right? Not really, but this is how we model it. Okay, so what we're saying is that stream of cash flows that we're going to model it this way because we're looking 4 years out, and we're saying, all right, after 4 years, we're just going to kind of take a swag and say that it's going to grow at 3%, and we're going to continue to evaluate our firm as having about a 10% required rate of return on equity, so it justifies about a 10% risk. What's really happening is we're saying, so when we did EP0, right, we were saying, well, the market says, for example, based on the last dividend of 110, the market says that this stock would be selling at 1,400, or the market, the P0, right? The market is saying, we look it up, we looked up the stock value, we're like, oh, it's selling at 1,400. And then we did the calculations here that we just did, and we come up with 1,600. What did that tell us? Was the market undervaluing the cash flows, or overvaluing the cash flows, or accurately valuing the cash flows? So what I'm saying is, you look on Google Finance or Yahoo Finance, and you look up the last stock price, and it says that it's 1,400. Do you believe that the market is correct? Okay, so no. You believe what? Is this a stock that you want to buy then? If you see that it's currently trading at 1,400, you've just done an evaluation and said, it's really worth 1,600. That's a stock you want to buy, right? Because you have some deep insight, right, that the market apparently does not have. So that you're saying, okay, based on my evaluation, this stock should be 1,600. So I'm going to buy it today because it's trading at 1,400, because I believe that if I have faith in my evaluation, then I believe that it's really worth 1,600. And sooner or later, the market's going to figure it out, and the price will come up to 1,600. All right. So, but that was the point there that I'm trying to make there is, you are making an evaluation of the value of the stock today, right? So the stock market, you look up the value of the stock market, the value of the stock on the internet right now, and it says 1,400. You've just done a calculation that says, no, it's really worth 1,600 right now. And there's an error in the market someplace. Somebody's missing some information that I have. And that could be because you have insider information, right? Maybe you're the CFO and you're like, yep, market's undervaluing us. At that point, what they might do is a stock buyback, which means they go on the market and they buy back stock because they believe they're undervalued. They're not going to issue new stock. So those are more complex issues. What I'm trying to make a point of is that valuation is at time 0 when we did it. What we're saying is, we've got 0, 1, 2, 3, 4. 5, right? And so we said the cash flows coming off this project are going to be 50, 65, 85, 110. Then we said year 5 is going to be 113.30, right? And then it's just going to keep on getting bigger out here. What we just calculated was the value of year 5, 6, 7, 8, and so on. And we're saying that at the end of year 4, we would be willing to pay 1618 for the 113, the one, whatever the next one is, and so on and so on. So we'd be willing to pay 1618.57 for this portion of the cash flows. Cash flows to the right of year 4. We'd be willing to pay at the end of year 4, we'd be willing to pay 1618. Okay. And what we've already said is, what Brianna said was to get the present value of all these cash flows. We just did that. We said these cash flows, they're worth 238.16. These are worth this. Sorry. These are worth this. But this firm is not just those 4 cash flows. This firm is those 4 cash flows plus the cash flows that start at year 5 and go on forever, which we just said are worth 1618, but at the end of year 4. So out 4 years from now, we're saying that we've got an asset worth $1,600. So if we're trying to figure out how much is this firm worth today, we've said that, well, the first 4 cash flows, they're worth 238 today. What do we need to do to figure out what the full value of the firm is? So it's 238 plus something else, right? It's whatever this is worth. So how do I figure out what this is worth today? $1618 is a future value, and I want to know the present value. So what am I going to do? I've got to bring that 1618 back to the present. How many years am I bringing it back? 4, at an interest rate of 10%. So I can do 1618.57 divided by 1.1 raised to the 4th power. That's one way I can do it. 1618.57 divided by 1.1 raised to the 4th. 1050, probably 1105.51 is probably, yeah, 1105.51 would probably be more accurate. Not that the pennies matter in this case. So that's one way I could do it. What's another way I could do it? TVM. Clear my TVM. 1618.57 is my future value. My interest rate is 10. My N is 4. Compute PV, and I get 1105.51. So either way you do it, 1105.51 is the value of the going concern after year 4, right? That's the value of this portion of the cash flows. I'm going to add that to the value of the rapid growth phase, which is 238. And I get 1343.67. Another way you could have done that same problem is you could have said, all right, I got 1, 2, 3, 4 at 50, 65, 85, 110, is I could have said, hold on, and I know EG is 3. This is the exact same problem, just copying it over. RRE is 10. What I could have said was, well, I know at the end of year 4, this 110 is going to grow into my terminal value. So let me calculate that first. Let me shut my email off here. Let me calculate that value first, because I know that what I'm going to wind up doing is having this 2 values at year 4, at the end of year 4, that I've got to bring back to the present. So what I can do is just add these 2 together to start with. So I do my terminal value, right, and first, and my terminal value again is that 1618. I'm not going to do it. 1618.57. We just did it. So now I can say, all right, the 4 values that I have are 50, 65, 85, and 110 plus 1618.57, 1728.57. Right? And now I can just take the 4 present values, or I could use the cash flow register to get my present value of these 4 cash flows. So you could do, all right, the same thing we did a minute ago. 50 divided by 1.1 raised to the first, 65 divided by 1.1 raised to the second, 85 divided by 1.1 raised to the third. And then instead of doing 110 divided by 1.1 to the fourth, I do 1728.57 divided by 1.14 to the fourth, because I've got 1, 2, 3, 4, 0, 1, 2, 3, 4, right? I've got 50, 65, 85, 110 plus 16, 18, 57, 17, 28, 57. So I've really just got these 4 cash flows. However you want to bring them all back to the present, doesn't really matter to me. Whatever works easiest for you. But they all have to come back to the present. The main thing to remember is that I've got to get that terminal value for the constant growth phase. And I got to know where that hits. So I can then do, if I want to do, say, cash flow register, I could do cash flow 0 is 0, CO1 is 50, CO2 is 65, CO3 is 85. And instead of doing 110 this time, I could do 1728.57. NPV 10, compute, and I get 1343, which was what our answer was here. So there's multiple ways you can approach this. This may actually be the most straightforward way. All right. Another one. Got 1, 2, 3, 4, 5 years with cash flows of 120, 156, 203, 264, and 343. After year 5, we're going to go into a constant growth rate of 8%. And our required rate of return is 18%. Let me suggest you try this approach where you just do the terminal value, add it to your last cash flow. constant growth begins after year 5. So rapid growth is through year 5. Constant growth begins after year 5 at a rate of 8%. What is the year 6 cash flow? Just out of curiosity for a second. What is the year 6 cash flow? Yeah, it's going to be 370. How'd you get it? Right, right. So we said because year 6 is now in part of the constant growth phase, we take the last cash flow from the rapid growth phase, which is year 5 at 343. We multiply it by 1.08. That gives us 370. And if we were going to do year 7, we take year 6 times 1.08, and we get the next one, and so on and so on, and on forever, right? Because it's going to be a going concern. So, how do we get the terminal value for this, for the constant growth, the value of, call it the terminal value, but the value of the cash flows during the constant growth phase? How much is it? Okay. So instead of calling this P0, we'll call it terminal value. And instead of calling this D0, we'll call it cash flow. Right? But otherwise, it's the same math. But somebody help me set it up. What am I going to do? Okay, 343, because that's the last cash flow from the rapid growth phase. Good. So times the expected growth rate. So times 1.08 divided by good. So that's going to be 10, right? That's going to be 370.44. So 370.44 divided by 10. 0.10 is the same thing as multiplying 370.44 times 10. That's why that'll make you look smart. You know that if you're dividing something by 0.1, it's the same thing as multiplying by 10. 370.44 becomes 3,704.40. So the terminal value, the value of year 6, 7, and so on, all the way into infinity, is worth 3704.40. If we want to now get the value of this firm, the projected value of this firm. What are we going to do? We've got to do what? We know that the cash flow year 1 is worth 120, year 2 is worth 156, year 3 is worth 203, year 4 is 264, year 5 is 343 plus 3704, it's 38 something. 41 something, 40 something. We've got to do what, Molly? What do we got to do? Yeah, so all right, so let's do that. 3704.4, right? That's 407, 484. Okay. So we've got these 5 cash flows, and we want to know what's the value of this firm. Did I do it wrong? 343 plus 3704.4. 4. I did do something wrong. 47. So it should be 4047.84. What am I going to do now? I can't hear you. What? The present value? Okay. So what's your approach going to be? Add them up? Well, these are all the future values. This is the value at year 1, out at year 1. This is out at year 2. So you've got to discount them all back to the present, right? In some way, you've got to discount them back to the present. So you can do 120 divided by 1.18, 156 divided by 1.18 squared, 203 divided by 1.18 cubed, 264 divided by 1.18 to the 4th, and 4047.84 divided by 1.18 to the 5th, right? You could do that, or you could use your cash flow register. Make sure you clear it. And you could say cash flow 0 is 0, 1 is 120, 2 is 156, 3 is 203, 4 is 264, and 5 is 4047.84. And then you go to NPV, and we're going to use the required rate of return on equity. That's 18. Compute, and you get 2242.80. So what did that, using the cash flow register, what I did was I told it, I've got a stream of cash flows with no investment, right? So normally when we use the cash flow register, we've got an initial investment of something that's negative, and then we have a stream of cash flows, and we say, give us our NPV, right? In this case, there's no initial investment, so we just make CF0 0, and then CO1 is 120, CO2 is 156, and so on down to here. Then we tell it what we want to use as the discount rate, and it gives us the present value of those 5 cash flows. So the value of this firm would be 2,242.80, assuming that these estimates of the future are correct. The growth rate is really going to be 8%, and the appropriate discount rate is 18%. You all look stunned. Shall we do one more, or are we ready to move on to something else? One more. Short one. 1, 2, 3, 100, 150, 250. EG is 7. RRE is 15. What is the value of this company? Rapid growth phase is going to last 3 years, followed by a constant growth, followed by constant growth of 7%. So the way I would phrase this on the test would be something like, you are you are a venture capitalist, and you are evaluating a new a proposal from, a entrepreneur, and she says that her projected profits will be 100, 150, and 250 for the next 3 years, followed by a constant growth followed by constant growth of 7% forever. She believes that you believe that the appropriate discount rate based on the risk would be 15%. What valuation would you attach to this business? What valuation? What value? That's our funky finance phrase for how much is it worth? How much would you be willing to pay for this? I could say it a couple of different ways. How much would you be willing to pay to invest in this company? What's your estimate of the value of this company today? So in year 4, the cash flow will be what? How would you get it? 250 times 1.07, right? Because it's going to grow constantly in the future at 7%. And then the year 5 cash will be 250 times 1.07 times 1.07, and so on forever. The first thing we want to do is get the what? Terminal value, right? The terminal value is going to be based on the last cash flow from the rapid growth phase. So how am I going to get the terminal value? Linda.
Times 1 plus 0.07, and then divide that by 0.15 minus 0.
Good. So 250 times 1.07 gives me 267.50. 0.15 minus 0.07 is 0.08. So divided by 0.08 is 3343.75. Okay. Now what? Did I do it wrong? Making this one up. I'm making this one up on the fly. So Maddie, now what? Well, you said you wanted one more, so we're
I don't know. No one was answering.
What's that?
No one was answering.
Okay. So you did. No one was answering, so you said one more.
Yep.
Okay. There you go. So I got to add that to the 250, right? So that gives me 3593.75. So Maddie, what do I do now? So I've got these future values, right? And I want to know what the business is worth. So I've got to do what with these future values? Bring them back to the present, all 3 of them, right? Because the value of the business is the 100, the 150, the 250, plus all the cash flows that come after 250 that are going to be based on 250. which we know is worth 33, 43, 75, but in year three, at the end of year three. So that one's happening out at year three. So we could do it kind of one of two ways. One is we could do 100 divided by 1.15, 150 divided by 1.15 squared, and 35, 93, 75 divided by 1.15 cubed, right? Or we could use our cash flow register, which is maybe a little faster and probably more accurate, because we're less likely to make a mistake. So clear our cash flow. The CF0 is what, Maddie? Do we have an initial investment? Nope. So it's going to be 0, right? Then we're going to scroll down. CO1 is going to be what, Maddie? CO2 is going to be? And CO3 is going to be? Then we go to our NPV. We set I equal to what? Scroll down to NPV, compute, we get 2563. So the value today would be 2563 and some change. So how much would you be willing to pay for this business? You'd be willing to pay $2,563.33. All right, we're going to do a related problem now. I sent you a spreadsheet. Pop that bad boy up. All right. Looking at the FCF example, you have the completed version. So one of the nice things about this spreadsheet, this workbook, is I'm giving you all the answers. So you can cheat and look at the answers. It's useful for practice. Go in and try to practice it with, so save a version without answers. So what do we got? We've got a business that starts in 2020, goes through 2024. So it's got 5 years of projected cash flows. After which it's expected to grow. So that's the rapid growth phase. It's going to be a value after the end of year 2024. It's going to grow at a rate of 3%. We're going to evaluate this firm at a required rate of return of 18%. Ignore these numbers out to the right. I don't know what I was doing up here. So let's walk through this. This is a projected income statement. So we've got revenues starting in 2020. They think they're going to earn 105. Then that revenue is going to grow to 126, then 151, 174, and slow down finally to 191. So it's pretty rapid growth. It's almost doubling in value in 5 years in terms of revenues. Right? Just real quick, using our rule of 72, ballpark what the annualized return is for that. If we're going to almost double in 5 years, what's the implied rate of return? Do you remember how to do this? It's not going to be on the test, but it's a useful tool to have in your toolkit. Rule of 72 says what interest rate, right? Divide 72 by either the interest rate to get the number of years it'll take to double, or by the number of years to get the interest rate that it'll take to double. So say if we take 72, and I know this is not a perfect 100%, but again, we're just doing a ballpark anyway. So 5 years to double. 72 divided by 5 is 14.4. So this is approximately a 14.4% growth rate on its revenues. Just interesting to have. I'm just throwing that out there as a thing for you to be able to do in your head, right? These are the little tricks of the trade that finance people just kind of do. All right, so we know that it's going to be growing. Now, as revenues grow, we're gonna have these patient service expenses. So these are things that money we're gonna spend on actually taking care of patients. That might be staff salaries, physicians and nurses and PSRs and so on. Then we have some other expenses that are other than interest, depreciation, and taxes. So we have some other expenses like insurance, and rent, and other stuff like that, right? Then we're going to take depreciation in each year of some amount, 8, 8, 9, 9, and 10. Doesn't matter. We're not. That gives us, so we take our revenues minus our various expenses. We get our EBIT, our earnings before what? Interest and taxes, right? So this is something that should be flowing off your tongue at this point. EBIT, EBITDA, right? EBIT is earnings before interest and taxes. Then we go and we say, all right, how much interest are we going to pay? Well, we're going to pay $4 million, let's say, right? So they've got their earnings, their EBIT is, kind of just your core earnings, right? So this would be like your operating income if we were looking at. It's not perfectly following our nice, neat income statement that we worked on before, but it's pretty close. So this is roughly our operating earnings. Then we say, all right, interest expense. We're going to pay this much on our debt that we've got. That gets us to our earnings before taxes. We've got 4 left over. We've got a tax rate of 40%. So our taxes are going to be 40% of our EBT, our earnings before taxes. So 40% of 40 is 1.6. Earnings before taxes minus taxes gives us our net profit. We've paid our taxes, we paid our interest, we paid our depreciation. We got this net profit. So so we've done all this, right? And so you just kind of follow it over. You can see that they're growing. Like that net profit is going from 2.4 to 13.2. That's a pretty darn nice growth rate, right? Which is not uncommon to see businesses have low or negative, right? Either they have low amounts of profit or they lose money in those early years because they're making initial investments to grow. And then they grow into that. And then you can see, okay, 13.2 is where we're going to kind of stabilize. And then from there on out, we're going to be growing at a constant rate. Now, what's this estimated retentions? This is a new concept for you guys. What estimated retentions is remember, what can we do if we've got net income, if we're a for-profit business and we've got profit at the end of the year? The 2 things we can do with them is we can do what? We can retain the earnings or pay a dividend, right? So the idea here is we've got this net profit of 2.4. And what estimated retentions is the amount of cash that the firm needs to hold on to, needs to retain in order to continue to grow. And you say, but Professor Bonica, they only have 2.4 million in profit, and you're saying that they need 4 million to retain to grow. And I say, you are correct, right? Indeed, the estimated retentions exceeds the net profit. Does the net profit actually reflect the amount of cash that the business brought in this year? You say, no, Professor Bonica, because depreciation. Very good, Brian. Thank you. So if I want to get a more accurate estimate of the cash flows from operations, what am I going to do to net profit? I'm going to do what, Brian? You said it. What am I going to do with that depreciation? No, I'm not going to try it. Other way. I'm going to add it back. Why am I going to add it back? What kind of is depreciation when I write a check to my depreciation vendor? Do I write a check to my depreciation vendor? Do I have a depreciation vendor? Like, does somebody sell me depreciation? No, right? That's just kind of silly. Okay, so what is depreciation? It is what kind of expense? It's not a cash expense. It's a non-cash expense, right? Depreciation is a non-cash expense. It is a fiction. It is an accounting fiction that we use when we do when we're trying to figure out what the economic value is that the firm has created in the course of the year. Why do we do depreciation? Why do we plug? Why is there a depreciation is not cash? Why are we even bothering with it? What is the purpose of having a depreciation amount in each of these years? What do we depreciate? I said this on the makeup exam. Folks were trying to depreciate net income or something crazy like that. What? Equipment, right? So we depreciate equipment. Why do we depreciate it? Instead of expensing it in the year we buy it, we depreciate it. So what do we why do we do that?
That looks like you want to spend $100,000, but it's gonna last longer than 1 year.
Right. So in the year I bought the stuff, if I expensed it, exactly, if I expensed it in the year I bought it, meaning I took it as my full charge, so I buy $1 million, a $2 million MRI, right, in year at time zero, or in year one, and I make $500,000 in revenues in year one, I wind up with 2 million minus 500. I look like I lost $1.5 million in year one. Did I really lose 1.5 million in year one? Fire the manager, right? Year two, if we expense it all in year one, year two, there's no expense for the machine, and they make $500,000. The new manager looks brilliant, right? The last manager looks terrible because they spent $2 million in their year, only earned $500,000. That means they lost 1.5 million. And then we fire him, right? We hire Brianna to be the manager now. And in year two, they make $500,000. And it looks like Brianna's a genius, even though they made the same amount in both years, right? So what Linda was saying was, if I buy that MRI machine in year one, I don't want to take the full cost of the MRI machine in the year I buy it, because that MRI machine is going to last me, I'd say, 10 years. So what I'm going to do is I'm going to, instead of taking the full $2 million in year one, I'm going to take a little bit of them. I'm going to take a little bite, right? 10-year life, I'll take 2 million divided by 10, and I'll take $200,000 in depreciation each year. So when the manager in year one buys the new machine, they earn $500,000 in revenues from the machine, and then they have $200,000 in depreciation. That's a little more accurate, right? They used up about $200,000 worth of the machine because it's got a 10-year life. They used it for 1 year, and they had $500,000 in revenue. So 500 minus 200 is net income of 300 instead of a loss of 1.5 in year one, and then fake profits in years 2 and on. So we depreciate to get a more accurate representation of the economic value being generated in each year. So what we're trying to do is match the resources used, in this case, right, the depreciation represents the amount of equipment and property and equipment that's kind of used up during that year to generate $105 million worth of revenue. In reality, the equipment, property, plant, and equipment probably cost, $100 million. And so they're taking 8 million of it that year. They're not going to take the full 100 million in year one, because that would make it look ridiculous. So we're going to add back the depreciation because it's not a cash expense. It's just it's meant to help us understand the value being created, but it doesn't actually capture the cash. So we want to get a better representation of the cash. We're going to take the net profit and add back the depreciation. So 2.4 plus 8 gives me 10.4. So now I say to you, hey, I think we need to hang on to 4 million. What do you say? Okay, we've got 10.4 came in, so we're going to use 4 million of that to fund our ongoing growth. So these retentions are the amount of cash that we have to retain to fund our ongoing growth. Does that make sense? So the estimated retentions is the amount of cash that we're going to retain from our cash flows to reinvest in the business. So if we want to figure out what we're going to talk about now is what we call free cash flow, which means it's the amount of cash that could actually be distributed back to the investors. So what would our free cash flow be? Well, it would be our net profit plus what, Brianna? Plus depreciation, but minus the amount of cash we need to reinvest in the business, our estimated retentions. So we actually have a free cash flow of 6.4. 0.4 million or 1,000 or whatever it is we want to talk about. All right. In year 2, we're going to do the same thing. Now our net profit's up to 4. Plus, we add back what, Brianna? Thank you. And then we subtract our estimated retentions. And so in year 2, we've got free cash flow of 8.8. So conceivably, investors could be pulling out this cash and the business would be okay. So now we're just going to continue that as a formula. Since we're working in Excel, we're just going to copy that over. So the cash flows for this business during its rapid growth phase would be 6.4, 8.8, 9.8, 10.2, and 11.2. Now, at the end of 2024, and I bear in mind, this is, I wrote this up a while back. So at the end of 2024, the business is going to enter its constant growth phase. So we're going to assume going forward after 2024, so into 2025, we said it's going to be 3% constant growth. So what would be the free cash flow? So we're going to build off of the last free cash flow. What would be the free cash flow in 2025? The constant growth rate is going to be 1.0, is going to be 0.03, 3%. The free cash flow in 2025, the year after the end of the constant growth, would be what? Did you get it? So I know that the free cash flow, the last free cash flow that we're calculating is going to be 11.2. And then after that, we're going to enter a constant growth phase where we grow at 3%. What would be my 2025 cash flow? How much? I didn't hear you. I'm not.
2025?
So in 2025, right? So that 2025 is the next year. Yeah, how'd you get it? Okay. What did you do? Yeah. EV. Okay.
And then willingness.
At the end. Yeah. All right. So Brianna did use TVM and she said, I know N is 1 because I'm going to go 1 year forward. I'm going to go forward at 3%. So my I is 3. My PV is my initial value. That's 11.2. What's my future value? And you got 11.53. All right. What's another way to do that? That totally works. Probably a little more work than you need to do, but it totally does work. It's going to grow at 3%. Exactly. So I could just say, all right, if I want the next one, I'll just say equals this times 1.03. and I get 11.5. So what you did is not wrong. It's just probably was a little more labor intensive than it needed to be. Right? And then if we did it, if we wanted to know what 2026 is, we could just copy this out. The next year will be 3% more than that, and so on and so on. Since we're in Excel, we could just kind of keep on dragging, right? But, and then we'd have to eventually get the present value of all of that, right? Because we want it. So the price of anything is its present value. So we don't really care. We don't actually care about these numbers. I'm just talking. So based on what we did a minute ago, well, not a minute ago, but the first couple examples we did at the beginning of the chat of the class. What do I need to do? So I've got the 5 years of rapid growth, and then I tell you, starting at the end of year 5, going into year 6, we're going to go into a constant growth mode. How do I figure out what do I need in order to value this company? I need to know what. And it's right there at the bottom. I need the terminal value. All right. So how am I going to get the terminal value? Yep. So 11.2. Yep. So 11.2, and we said the EG was 3, and the RRE is 18. So PV is equal to 11.2 times 1.03, right? So we have the last cash flow times 1 plus the growth rate divided by, is that thunder? All right. 0.18, 0.03, right? The RRE minus the EG. Doesn't like a good thunderstorm. All right, so what do we got? What is our terminal value? Jasmine, what's our terminal value? 76.9. You can do it in Excel, it's fine. All right, so you should get it 76.9. Everybody with me? All right, so we know that our terminal value is 76.9. Let's go back to the spreadsheet. So I could put that, I could type that formula in, and I could just say, all right, it is 11.2 times 1.03. I'm just going to hard code it because I'm not that worried about this. Divided by 0.18 minus 0.03. And let me just pause there for a second. A lot of folks forget, if I tell you, hey, it's 18%, RE is 18%, a lot of people write 18 and then 18 minus 3 instead of 0.18 minus 0.03. And so now you're dividing by 15 instead of 15% or 0.15. That you wind up with a very different answer. So just remember, when you're doing formulas by hand, you've got to convert back to decimals. All right, so 76.9, a little rounding, right? Okay, so in order to get the value of this, firm, we need to take the present value of each of the cash flows in each of the years, right? So in year 1, we've got 6.4, year 2, 8.8, year 3, 9.8, year 4, 10.2, year 5, 11.2 plus 76.91. So let's just go ahead and add that. And here what we'll do is we'll just add the whole column. We'll slip in an extra row here. So we'll do equals sum. And this is just strictly doing for the Excel because we're working in Excel, just to make my life easier. So I'm just summing up. The only one that's really affected is this one, right? Because everything else is just adding 0 to it. But what that does is it gives me all of the values in one row. So I've added 11.2 and 76.91 to get 88.11. And now I need the present value of that stream of cash flows. So since you won't have access to Excel during the exam, you'll do probably the easiest thing would be your cash flow register. So let's go ahead and do that. And I'll show you how to do it. I'll remind you how to do it in Excel. But we've got, let's see, it was 6.4, 8.8, 9.8, 10.2, and then how much was it? 88.1. All right. So cash flow register. No CF0. CO1 is 6.4. CO2, 8.8. CO3, 9.8. CO4, 10.2. CO5, 88.1. And then NPV, we know that the RRE is 18. Oops. NPV, 61.47, 61.5. Everybody with me? All right. That's the kind of manual way to do it. You know, the easiest way to do it in Excel is to type in equals NPV. And again, remember Excel. In Excel, the Excel formula NPV is not actually the NPV, it's just the present value. And I really don't know why they call it the NPV. So just reminding you that it's not actually an NPV. We're going to take the rate. So, and if you're working in Excel and you need a little bit of help, you hit the FX button and it says, what's the rate? And it'll even tell you, hey, the rate is the discount rate. What's the discount rate we said we're using? %, right? And we've got to write it in as 0.18 here. And then with the values, we can just grab the whole row of values and then hit OK. And we get 61.48, 1.5. All right. So take away from this one. Same process we did just using the cash flows. On the exam, I'm going to give you something like this. And I will tell you, I'm not going to make you guess at the retentions. If we were in a more advanced class, we'd be estimating what the retentions are or would need to be. I'm going to give you the retentions. So you need to remember how to get to free cash flow. So to get to free cash flow, if I'm presented with an income statement, to get to free cash flow, I'm going to take my net income plus what, Brianna? Plus depreciation, because depreciation is what kind of expense, Linda? Non-cash. That's what you were trying to say? Yeah. Right. So plus depreciation, net income plus depreciation gives us a very rough estimate of cash flow. Right. This is a technique we learned back in chapter 3. So net income plus depreciation gives us a very rough estimate of cash flow. Then we're going to say, this is a growing business. It's going to have to retain some of its cash in order to keep on buying old equipment, replacing its old equipment. So we're going to add back some amount of estimated retentions. I'm going to give that to you. Right? So then you'll get to your free cash flow. So your free cash flow estimation will be net income plus depreciation minus estimated retentions. That'll give you your free cash flow. once you have all that, you're going to say, all right, where is the end of the rapid growth phase? You're going to say, in this case, it's 2024, but whatever it is on the exam, you'll say, okay, I need to know what the last free cash flow is. That becomes the basis of my terminal value. Then I use the terminal value formula, or what we used to call EP0. So I plug in the last free cash flow, which in this case was 11.2, right? That becomes my D0 in the EP0 formula. Then I multiply that 1 plus the growth rate divided by the required rate of return on equity minus the growth rate. That gives me the terminal value. I add the terminal value plus the last free cash flow. So 11.2 plus 76.91 gives me that 88.1. Then I use whatever technique I have available to get the present value of all of the free cash flows. That gives me the value of the business. I got a minute, so I'm going to do the last. The last thing is actually really easy. So that's one way that we've spent the first 2 sessions on business valuation using the free cash flow method, right? We're really just now calling it the free cash flow method, but that's what it is. We're using the free cash flow method to estimate the business. Another way that you'll do it is you'll do it kind of the way they do on Shark Tank, right? Which is you're going to look at what the expected EBITDA is, the earnings, the operating earnings, and you're going to multiply it by what we call a market multiple. So you'll hear the shark say something like, "Well, I think your cash flow is going to look like blah, and I want that to be 10x or 5x." You'll hear that that kind of phrasing. So in this case, what we're going to do is we're going to take the EBITDA, the earnings before interest. I'm not babbling. The earnings before interest, taxes, depreciation, and amortization. Amortization is the same thing as depreciation. You just use it for things like intellectual property. So if you were to buy a patent for $1 million, there's nothing there, right? It's just an idea. You've bought the rights to an idea. So we amortize non-physical things, and we depreciate physical things. So when we say EBITDA, depreciation and amortization, it's basically the same idea. It's just one's for physical stuff, one's for intellectual property. Right. So how do we get EBITDA? Earnings before interest, depreciation, and taxes. Well, we go up here to the EBIT, and we add back the depreciation. So the EBIT is 8. EBITDA, earnings before interest and taxes, earnings before interest, taxes, and depreciation. Well, if we've already got earnings before interest and taxes, to get to earnings before interest, taxes, and depreciation, we just add back depreciation. So what would the EBITDA be? Well, if EBIT's 8, what's EBITDA in this case? 16. 8 plus 8, right? So 16. So if I say, hey, we use them for businesses like this, we use a market multiple of 4.5 times EBITDA, we're going to take equals 16 times 4.5. Oops. And we get 72. It's that simple. All right, next time we're going to talk about leases. It is exciting.